It jumped off
Okay.
my computer. Oh God, you're
Yeah. So I think moving forward too is that we are going to, because there are people that's out there. I'm sharing all this not to scare you away from investment, but I think there are people out there, and the syndication is a very, very small world. The appearance of success does not mean the real success. There's a lot more sausage making behind the scenes, right? And then one of the criteria what you should betting on, and thanks for Kaylee providing these opportunities for people to kind of learn about it, is like what are things that you're dealing with right now? Because I bet you everybody's got one or two deals that they're struggling with. And it's usually forced to buy the rate caps. It was really funny. I was leading a panel on a very prestigious talk in Phoenix one time. And I was asking, it was a small group discussion, and it wasn't that small. It was about 70 people kind of showed up over there. And it's all people who are actually owning the properties, right, at the current period of time. And then basically I asked a question pretty point blankly, hey, it's a closed door discussion over here. How are you guys doing? How are you mitigating with a high interest rate? What's your strategy? And everybody's like, oh, we don't have a problem. We have a fixed rate debt, right? So next question I asked, I was like, who out of here all have bridge loan on your deals, on any of your deals, right? Like pretty much everybody in the room raised their hands like, are these fixed rate bridge like no, they're floating. Well, so it's clearly conflicting with each other. So in these functions, not everybody's going to be talking about their dirty laundries. And I would say anyone who has some experience with the industry right now, it's a little bit hard time. So we all have one or two deals that is of a little bit of a concern. And then now it's the time for a good operator to kind of really shine and going through a hard period and then returning back, like how did I actually take something that's anomaly caused by the market rate changes so rapidly and actually make something out of it, right? So that's kind of like, the experience comes in terms of how they deal with these issues. So I think it's in some extent that your challenges are kind of blessing in disguise. And again, some investors going to be demanding on like, hey, where's the distribution? Why are you holding the cash?
oh
But
my God,
in the
yes.
larger things,
Oh,
right? In the larger grand scheme of things,
we're having
I
it.
think losing the property is the number one priority that you do not want to go there. So then the second priority is doing a cash call. That's has to be a last resort. And the making sure the general partners actually have a lot of skin in the game, because there's going to be a point the general partner will be tapped out as well. That's when they go to cash call. But also working with the lender, because lender is also hurting right now. So having these honest conversations with lender and be able to have that conversation and creatively come with any structures that can like prolong or lower your interest period, lower your interest rate or payments or any of that stuff is a good time, right? Just don't show up. You don't want basically investing with people who that doesn't kind of just show up and
Mhm.
doesn't do anything with it. Proactiveness is the biggest lesson we learned from like all these challenges we had. We were very proactive, as I mentioned before, with the property management downfall, what we had with this particular management company in Houston. We were very proactive. Like the minute that we got a wind of this maybe happening from a tip off, is like we got on the phone call with the lender immediately. And then we thought about every way to block the money flow going to that company, because your property management company holds your bank account,
Yeah.
right? There's not a way to do that. So we leveraged actually lock boxes to lock up all the sweeps and all the other stuff to try to prevent any losses over there pretty timely. And then through that whole process, we realized like our lenders are really kind of, they're not your friend. But
Mhm.
you guys are in there together.
Yeah.
And the lender do not want to take the property back. So they're gonna do whatever they can in their power to help you out to make sure that the deal doesn't actually default back to them. Right. And then all the lender did, all the deals last year, this year, Most of them are done on bridge loans because market was really hot. So they have this giant size of the notes that's on them. So
Yeah.
their goal is to prevent the defaulting of these notes as much as possible, because that's how they can go in there, right? So working with your lender on this is a very important key on that. And again, if you're experienced sponsor, you have a lot of deal with the same lender, this is where the relationships start to really work for you.
Yeah.
So checking in with your lender more often is one thing that I would say. Definitely, you want to make sure your sponsor have a really good relationship with your lender.
Yeah.
We're very relationship based. So we pretty much only do loan. Yes, the direct lender that we have contract like multiple bridge loans, but we only deal with 2 houses of lender or lender broker, right? So 1 house of a lender broker and then 1 house direct lender. We have like 7 loans with Arbor directly, we're on their special client list. So these kind of helps us when we're talking with giants like Arbor and, direct lenders on that. And then from the management perspective, I think having clear KPIs are very important, but also having the right asset manager on this is really important, and the right team. So we have like 18 deals right now. So obviously it's not me that's running them all. We have asset managers running them as well. But that kind of also another layer of it, check and verify and making sure your vision is actually being implemented over there, right? Just don't just assume that everybody knows how to do their job. Is one thing too. So check and balances are very important. We get great questions from our LPs. We should welcome them, and we try our best to answer them in a timely manner. I think communication is really a key. Communication is really a key going into the next cycle, because here's a silver lining on this is since last month or 2 months ago, the market has really adjusted. Right now, it's really a good time to picking up some really great deals. The price per pound prices has really come down, right? It's probably going to take a minute to recover, but this is now the time to actually talk to more investors, get drummed up and start buying new deals versus getting scared with like, oh my God, like we bought deals like two years ago, a year ago. They're kind of stuck right now, so I'm not going to invest at all. But right now is a good time to kind of picking up the deal, right? Like Warren Buffett has kind of talked about, being what do they say, like be cautious when everybody else is greedy.
Be fearful where others are greedy, and greedy when
Right.
others are fearful.
Yeah.
Right. So now is where everybody is fearful. And then if you can get a deal work, you can pick up deals for very discounted rate. And so this goes into the books of buying low, selling high, right? But very important thing is ask more question about debt structure. Are they using fixed rate debt? What's their mitigation? What's the period on the fixed rate debt? If there's a second layer in piece over there, what is their term? Is that fixed as well? I think that will take a lot of ambiguities out of the equation, but not fixed rate debt's always good because they do come with a big prepayment penalty. So any deals that you buy right now, don't expect just in the last couple years. The reason why we have 40-50% IRRs because we can sell a deal in a year, in the 2 years, 3 years, whatever, right? Like nothing was sold more than 3 years, a holding period of time. But now you should be expecting you will be in the deal, be patient. You will be in deal probably for 5 to 7 years, because there is a recovery of the market. And then also if you put them on a fixed rate debt, there's prepayment penalty. So when the interest rate drops, the market's going to recover. But at that point, there's a big prepayment penalty. So, the strategy will be more towards buying and holding to get cash flow for value, because price per pound, you're paying a really good deal for that. And also, but that doesn't mean that's less equity being deployed, because you probably need to raise more money for your deal you need more investors. So, I think it's a really good time to kind of start going out there, talking with investors, reassuring your current existing investors, and then be very transparent and explaining things that doesn't go well, the challenges, like I think most people who invest are very sophisticated investor, they should be. You know, and it's something that we take for granted, but making sure that we're educating our investors, sharing the truth with them. So I think these are just stuff that we're doing differently. We're also looking at more cost saving, such as utility cost saving. We implement some solar panels on some of our buildings. And most of our buildings are all bills paid buildings. So you know, looking at the bottom line, you know, because payroll is something that you can't really control. It's driven by the market. But you know, utility is a easy one to kind of save. And other things that can help you save costs, renegotiation contracts, right? Because I think right now it's a really weird market. The labor is really hot. You gotta pay a lot for that. But as we see, there's some loud firing going on in the tech world. And when that happens, you know, it's kind of dominant effect. So I think the unemployment rate is going to go up, and then you're going to be actually facing a lot of great talent. So it's actually maybe good time to try to spot for your talents for hiring. And because there's going to be more people on the market looking for the job. You know, with the property management changes and et cetera too. So there are some opportunities I want to kind of highlight over here, meaning like buying deals, more deals, you know, exiting some deals if you already kind of made enough. It's probably good to kind of like take the chip off the table. And then third is like, there's maybe some opportunities in the labor market that you can actually make your employee staff in a higher quality, which could mean it, you know, payroll is somewhat controllable too. I said not controllable, but if you hired really seasoned staff, then you may need fewer people. So your net may be okay. If you are thinking about that strategically. Yeah.
Lisa, that was so good. Thank you so much for helping us to educate our investors more. If it's okay, we actually have an online portal that I've been building up, different courses that we've had, and it's been specifically for women, but I want all of our investors to have access to it. So we did a course with my CFO where we went over how to detect fraud in your financials. We went, you know, looking at the balance sheet versus the trial balance and some other, you know, small things. She always ask me like, what am I looking at when I'm looking at my my numbers, you know, or just even talking about again, yeah, things seem scary maybe from the outside, but yeah, 100%. You know, I just got back from looking at some deals where it's not quite the market is ready, you know, for an opportunity for purchase, but because of some things that have happened due to COVID, disagreements, whatever built up over loan structure, blah, 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 partnership disagreement is happening. And so that becomes an opportunity a little early before the market, you know, is the opportunity. But I hear you. Yeah. Now's the time to go execute, you know, when everybody's like, you know, oh, I'm going to go buy high yield bonds. No. You know?
Yeah. That's interesting. I mean, like as investors,
No.
how to provide a little bit more content than just multifamily. And it's like, but we're not affiliated in any way. So, but it's like, hey, it's like a little bit more balanced portfolio. The way that you kind of compare this is like, do we think stock market can go down a little bit more? Possibly. It's more volatile than a hard asset. So now the question is like, where do you actually stash your money in the assets that is more sure, that has maybe more yield opportunities, and you know, I still think the multifamily is a very optimal investment.
Yeah.
Long
And
term.
one thing that I think I heard you say, of course, more reserves, you know, we've decided that luckily some of the mistakes I've made, you know, is that we didn't have enough reserves, but the assets were not $20 million properties to where I was like, okay, I'll fund it myself / you know, borderline, maybe a little bit of a cash infusion from some new investors. But so it wasn't as painful, I suppose. So now we've learned that lesson. Yeah, like 6 months OPEX minimum, you know. And then as far as, you know, looking at deals, I was willing to go into some nasty, dirty, like, no, now it's more like, okay, little changes into the interiors, you know, early 80s is ideal. And then, you know, so that way, when all these other factors change I can't control, at least we know we can still rent them. So
Yeah.
thank you for all of
Yes.
this, Elisa. I so appreciate you helping us to educate our investors.
Yeah, definitely. Looks really grateful to be up here. And then sharing some knowledges with everybody. Yes.
And I'll touch base with you offline about the PM and then NMHC.
Perfect. Sounds good. All
Thank
right.
you, Lisa.
Talk to you soon.
Bye.
Bye.
Happy New Year.
Where to just end it?
Yeah.